Hello, Internet friend. Today on Value Side, how to tell the difference between a stock market correction and a financial crisis. I'm David Ravel. Well, investor concern is palpable. This week, stocks declined sharply, especially after the rollout of President Trump's tariff program on Wednesday. Especially pronounced has been the decline in the NASDAQ Index, which up to now has been leading the markets to higher prices. But a careful review of this index shows that this week was merely an exclamation point of what has been an ongoing decline. The NASDAQ topped out for the third time on February 19th, having surmounted the 20,000 level. It had previously closed higher than 20,000 in December and then again in January. While the current decline is concerning, it represents only a 7% decline, one that Wall Street has not yet considered the signature of a bear market. That may come later, but we're not there yet. The question we have to ask, however, is whether this market decline is forecasting a much more serious systemic financial crisis like the one we saw in the period between 2007 and 9. During that time, a market crash foretold general troubles throughout the economy, most vividly demonstrated by the failure of Lehman Brothers, one of the country's most well-known and long-established investment banks. Most concerning, the contagion spread to even the Big Four largest banks in the nation. Citigroup was technically insolvent, mainly due to the declining value of collateral on many of its loans. Today, concerned investors look to the tremendous quantity of loans and leases that commercial banks now hold on their books. 14 years ago, during the Great Financial Crisis, commercial banks held $6.9 trillion in loans and leases, a tremendous amount of leverage that was put in jeopardy when a substantial number of home mortgages were foreclosed. The GFC shows us all that defaults, even in just one sector of a bank's loan portfolio, can impact the entire system. Today, commercial banks' loans and leases have nearly doubled since the GFC and currently stand at $12.7 trillion. Once again, real estate shows signs of risk, but not home loans. Today it's commercial real estate, those large offices, buildings, shopping malls, and industrial plants that are teetering on the brink of default. Now, the internet is full of videos of empty malls and office buildings that make up the bulk of CRE properties, most of which carry their own mortgages. Many developers and property managers must now reach deep into their own pockets to make those monthly mortgage payments. The question is, how long can they continue before they run out of cash? Of course, should the CRE market implode, it will substantially affect the frontline lenders. That's just how the dominoes began back at the GFC. But those mortgage lenders are just the first domino in our interlocking banking system. A broad-based series of CRE defaults eventually would work its way up to the very top of the pyramid, the Big Four U.S. banks, J.P. Morgan Chase, Bank of America, Wells Fargo, and Citibank. When the Big Four run into trouble, we'll know we're in a full-blown financial crisis, just like 2008, when Citibank became insolvent. The Federal Reserve immediately stepped in to pump liquidity into the system, a process they called quantitative easing. On Friday, March 4th, the nation's chief banker, Chairman of the Federal Reserve Jerome Powell, addressed a group of financial reporters in a speech that had been on the calendar for months. In other words, this speech was part of the chairman's regular speaking agenda and not in response to any specific concern over the new Trump tariffs or the stock market. As reported on CNBC, Powell indicated his lack of concern by saying, quote, "We do not need to be in a hurry, and we are well positioned to wait for greater clarity." He said unemployment remains at the low end of the target at 4.2%, while inflation is slightly elevated at 2.5%. As for the impact of Trump's tariffs, the Fed is adopting a wait-and-see attitude. In other words, Powell is not concerned with the mayhem on Broad and Wall Street at the New York Stock Exchange. Recent comments from both Chairman Powell and President Trump indicated that neither the Fed nor the administration is focused on stocks. Instead, they remain focused on the greater risk of a financial crisis. And here, Wall Street may be flashing an early warning that they haven't seen yet. Using our Big Four bank stocks as a proxy for the financial system, we see that the big banks did not initially participate in this market decline. In mid-February, investors were still relatively buoyant concerning the financial system. However, that upbeat assessment may have begun to change. In the past 2 weeks, the Big Four bank stocks have taken a hit, down on average 15%, with nearly half of that loss coming in the past week. Now, it's too early to suggest that we're headed into a financial crisis. Still, it's now when any good analyst puts down their markers, measuring the relatively healthy state of the nation's finances and its proxy, the big banks. Over the next few weeks, watch closely how the banks behave. Are there any special announcements of rising loan defaults? Do the banks expand their loan loss reserves? Watch the stories of significant bankruptcies and layoffs. See if the CRE continues to decline. Are there still mall closings and office buildings being foreclosed? To refer to Chairman Powell again, we're in a period of high uncertainty, with the odds of an economic and financial decline increasing. Using stocks as a predictive tool is fraught with distortions. Markets often overreact, and such may be the case with this latest reaction to Trump's tariffs. However, by watching both stocks and the major banks, we can get a pretty good sense of whether this stock market declines portends a financial crisis. Now, if you enjoyed this article, please consider buying me a cup of coffee. Go to buymeacoffee.com/David Rovell. That's REAVILL. Buymeacoffee.com/David Rovell. Thanks for listening.